Again, this was master planned out. None of this is the rhetoric it looks like from the hip. You think all these policies have been well thought out for the last 4 years while he sat outside of office. And again, there's going to be more eggs broke mixing this cake in the short run.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, finally, the day has arrived for the rescheduled Digital Assets Workshop. It'll be Wednesday, April 9th at 6:30 p.m. here in the Midwest Learning Center.
Unless there's a surprise snowstorm.
Unless there's another nature deals us one more blast. Yeah, the last one a month or so ago, we had to push back because of weather. Now, you're going to visit with Brad Starken, our financial advisor, who teaches this class in the next segment, so I don't want to spend too much time on it now, but just a quick 20-second summary.
If you don't understand digital assets or cryptocurrency, it's a great class to get you an introduction to it. This is not meant to go super deep. This is meant to get people understanding how it came about, where these are going to be useful and not useful in society, and whether or not they're going to stick around long term, et cetera. So he covers a lot of ground in the class, but this is meant to be a good introduction to digital assets because we do believe they're here to stay.
David, we have a brand new offering soon coming later this month. Exit planning for entrepreneurs. We need to start banging the drum for this one. It'll be Saturday, April 26th. Saturday, April 26th at 8 a.m. here in the Midwest Learning Center at Retire Smart. What is exit planning for entrepreneurs?
Well, it's actually tax planning and exit planning. So this is not just exit planning. This is proactive tax planning for business owners. We're going to have some legislative changes, pretty high probability that this year. We find that business owners, about 40% of the business owners that we consult on their tax planning, Chip, are completely operating in the wrong entity. In other words, they're just structured wrong from the get-go. And that's because someone just told them you should be X, an LLC or an incorporated or a sole partnership or sole proprietor. And they have no rhyme or reason why they're and it's costing some people thousands, tens of thousands, in some cases hundreds or even millions of dollars in excessive taxation. And so what this class is whether you're running a business now and you want to put more of that hard-earned dollars and revenues in your pocket by understanding how the tax code really works for entrepreneurs, or you want to exit and sell your business next year, 3 years from now, 5 or 7 years from now, are you set up properly to maximize the efficiency of your business and the exit to increase the net valuation that you put in your pocket when you do sell it, et cetera? So I've started over 40 businesses in my career, and I can tell you, about half of them successfully, right? Not all businesses succeed, but as you know, I'm the serial entrepreneur. But entrepreneurs, their net worth gets tied up in their business. Their focus is running the day-to-day. Very, very rarely do we find a business owner who's done the proper planning. And we find that almost all entrepreneurs are overpaying in taxes as they go. And if we could save an entrepreneur $50,000 or $80,000 a year in taxes, that's another person they could hire. That's a marketing campaign they could put to work to grow their business. Maybe they acquire another business, a competitor, or they could just take that home as additional profit to their business and feed their family, et cetera. So a lot goes on in this class.
Okay, let me make sure I understand. You're saying that you got hardworking entrepreneurs out there who may be leaving 5, 6, or 7 figures on the table in tax revenue for Uncle Sam that doesn't have to be left there. The Supreme Court has even said, as you point out numerous times, it's okay for you. You have a right to keep every dollar you possibly can. We're not talking about cheating the government, but people are leaving on the table.
Yeah, but they don't understand. The government actually incentivizes certain things to happen in business. There's over 1,000 incentives in the tax code specifically for business owners to reduce their tax liability, because if they do, that money gets put back into the economy, them purchasing goods and services on their own, or they're growing their business by hiring more employees, which creates more tax revenue for the government later. This is not tax cheating, loopholes, anything. It's understanding how the tax code is trying to incentivize economic activity. And most people are just not they don't understand it and they don't have an action plan. So this proactive tax planning is really beneficial. And again, this is a great introductory class to it. We're doing this is a breakfast class. This is for entrepreneurs. And if you've got a business that's doing, say, $1 million or more in revenue, or you paid over $75,000 between your personal tax return and your business tax return in federal income tax liability, this is absolutely a class you'd want to attend.
More on this as we get closer to April 26th. In the meantime, David, into the news we go. Well, it's Tariff Day, or President Trump is calling it Liberation Day. Now, this is a little bit of a risky business, asking you to look into your crystal ball, David Brooks. We record on Wednesdays. It's Wednesday, April 2nd. And whatever you think it's been so far, gamesmanship, bluffing, playing chicken, tug of war, leverage, whatever it's been so far, the Trump tariff policies take effect today. I'm going to throw a couple of headlines at you, David. One is they're both from CNBC. Trump's upcoming tariffs will be effective immediately, the White House says. So, he's kind of pulled back a few times, but no, the rubber meets the road today. And another CNBC headline, investors hope April 2nd could bring some tariff clarity and relief. That may not happen. David, what do you see in your crystal ball?
Well, later today, he's going to be making an announcement from the White House kind of defining what it is. But I don't think it's going to be necessarily good news for the short term, for the equity markets, et cetera. There's still going to be some confusion after this. But look, he's fundamentally trying to restructure to benefit the American worker. He's not, and this is where people get it wrong. They don't understand. This administration came in this time around focused on the people that put him in office, the American worker, union workers, auto workers, manufacturing folks, that a lot of blue collar folks that stepped up and voted for the Republican candidate, where traditionally maybe their class of voters may have not done that in previous elections. They are completely structurally set up to fundamentally change where and how revenue comes in to the U.S. Treasury. So they're attacking this a couple different ways. They're trying to reduce our spending, right? And that's what Doge is all about. By the way, we won't have time to get into it, but Elon has announced he's stepping out of Doge here in May. So we now know that this is the initial kind of bang is going to come to an end as we thought it would. But they're still trying to hit their goal of $1 trillion in savings. Howard Lutnick, who's the Commerce Secretary, is trying to increase revenue through helping them set up their economic policies for pro-growth. And all these tariffs are meant to make it more plausible for you to onshore jobs versus offshoring jobs, right? To create things that are going to be built here in America, to create services that will be here in America. And in technology, it's going to be huge on how some of this protectionism, if you will, is to keep some of the advancements in technology and quantum computing, AI, et cetera, in the United States, where we control this versus offshoring it to other countries where there's security issues, national security issues. So it's it's kind of complex, but it all aligns. Now, the other thing is understanding they have been messaging as you would expect them to do. And again, it doesn't matter if it's a Democrat or Republican in the office. When there's something goes wrong the first year they're in office, they want to blame the previous administration. That's just the way it's going to be. So they have constantly told you that this is Biden's economy and his market problems, et cetera. And they want these markets to go down, Chip. I've told you this for a while now because they need to get flight to quality to happen. And that's what we're seeing right now. And that flight to quality means people sell their stocks and their Bitcoin and they go buy U.S. Treasuries because it's guaranteed. The more people buy, that presses the yields down, and we have to finance that $9.6 trillion in debt this year. Again, this was master planned out. None of this is the rhetoric it looks like from the hip. You think all these policies have been well thought out for the last 4 years while he sat outside of office. And again, there's going to be more eggs broke mixing this cake in the short run. We believe the markets are probably high probability heading another 8 to 15% lower in the near term, next couple of months.
They get the pain over as soon as possible.
Correct. And then what he would love is then you get the tax cuts legislated, and next year that starts an economic rebound, and you'd see the markets rebound, jobs rebounding, all those things would happen just in time for the midterms, right? Again, why do we follow politics? It matters.
Yeah. Hey, David, I'll tell you one place where it's up, up, up. You sent the team a chart about the explosive IPO offering by Newsmax. And actually, right before we sat down to do this radio show, you shared with me a headline, conservative cable news channel Newsmax surges another 180% a day after stunning debut. Tell us about the numbers and what's going on here.
All right, so we haven't seen frenzies around IPOs. That's an initial public offering. Full disclosure, we do not buy IPOs for our clients. We will not buy stocks until they've been publicly traded for at least 2 full quarters. And I'll give you a great example of that. Facebook. I remember my dad years ago on Facebook going, hey, buy me Facebook. And I was actually on my way to a conference in an airport. No. You go open a retail account somewhere if you want to do that. I'm not buying it. And 6 months later, Facebook was down over 60% from its debut price. you don't get to see what's under the hood on the financials of these companies until they've made a couple of quarters of public reporting. You have the prospectus from the roadshow they sold this. And again, it's a conservative news outlet that doesn't make any money yet. Right now, that doesn't mean they won't, but it was highly subscribed. So they priced their IPO.
Are we looking at a sugar high then?
Yeah, absolutely. It's become like a meme stock. So it priced at $10 per share. It opened, right? It opened at $14 when it opened for its first day trading. It ran all the way up, as you see on the chart, over $70, right? The next day it ran to $190. Then it ran the next day to over $234. And it's whipsawing backwards over $100. It was down $120 already today. Again, that would value the company, Chip, at that $230 mark at over $28 billion. Their total revenue is $170 million, and they lost $72 million last fiscal year. They don't even make any money. So again, tread carefully if this is you. And again, my wife does watch a little bit on Newsmax. She's got 2 shows on there she likes, and we'll see. But again, this is a little bit of a frenzy. I'd say buyer beware. Caveat emptor.
I'm only going to give you about 30 seconds for this one, David, but I want to learn what this means. You sent the team a chart about the S&P 500 forward. Define that for us and tell us what you see in this chart.
So what we're looking at here is a chart basically looking at of 12-month forward-looking PE ratios. PE ratio stands for price to earnings ratio. So if we take the entire S&P and package them together, if it was one company, they have an earnings estimate, right? And what the estimate is looking forward 12 months. That estimate was about $275 by most of Wall Street. That has been reduced to about $250 today by most Wall Street analysts have been reducing their earnings expectations on companies. But we trade at a multiple, Chip. In other words, you're willing to pay a certain amount for a company, and that forward multiple gets stretched when the markets get to these all-time highs. And so we got pretty high up there. We're still outside the norm. And the average, as you can see on the chart, I put some averages on there. The 5-year trailing PE forward PE is about 20. Well, we're trading closer to 21, 22. We were as high as almost 23 not that long ago. But if you look at the longer term average, the 10-year average forward is much closer to 17, 18 range. And so that tells you that the market is most likely overvalued. So if it were to come down, this would make it more fair valued by one of the metrics you can use to price the market. And there's over 20 such measurements. This is just one of many that we look at to decide, do we think stocks are overvalued, undervalued? And again, that has nothing to do with should we actually buy or sell those stocks right now. It's just one of the things you look at in the fundamentals of where we are in the market cycle.
Up next, digital currency, cryptocurrency. It's not going away. You need to be informed about it. Stay tuned for the latest news in digital assets from Retire Smart financial advisor Brad Starken. He joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. As part of our continuing effort to inform and educate our clients and the general public on all manner of topics related to retirement, we bring you another conversation with our resident authority on digital assets. David, please welcome our special guest, financial advisor Brad Starken.
Thank you, Chip. Yes, once again, joining me in the studio is our resident authority on all things digital assets, cryptocurrency, and the like. And we've got a class coming up. Brad Starken, how we doing, brother?
I'm doing great. Thank you for having me. Yes, we have the class coming in next week, Wednesday, April 9th at 6:30 p.m. Hopefully, the weather is going to be good because we had to postpone the last one.
Yeah, and we had, I think, over 60 registrants. And I believe the majority of them have signed up for the new one. So it might be a standing room only class again, but it is a popular topic. So let's talk about, just since the last time you were on, a lot of changes. So current President Trump signed an executive order to create basically a reserve of crypto assets and a stockpile. Can you talk about those two things and kind of maybe what the difference is there? Or?
Yeah, certainly. So it's going to be the Bitcoin Strategic Reserve. So basically all the Bitcoin that's either we've been forfeited as part of like criminal activity or civil asset forfeiture proceedings that basically our government has, garnered through the course of time. And essentially what this executive order was stating is we are not going to sell that Bitcoin. We're just going to let that grow in the background, kind of almost as that digital gold, if you will.
And from what I understand, we collected, and I don't know if it's millions or billions, $380 million worth. I think it was millions, and forgive me if I don't know this, but I know it was 17 billion. It was almost a 15x on what it would be worth if we had not, as the government just sold. They just confiscated it and then basically liquidated it, right?
Yeah, that's been, over the past years of our government's been selling the Bitcoin, and basically, President Trump is going to put a stop on that. So anything that they will, get through various reasons, they're not going to actually go out and buy it to put it in here, but this is basically just stockpiling it for the strategic, or that's going to be the strategic reserve. And very similarly, that's what also the stockpile is going to be, but that's going to be other digital assets.
So the reserve is literally going to be Bitcoin, which is basically a form of store of value, right? A digital store of value. The stockpile is going to involve other cryptocurrencies or digital assets. You and I talk about the different various kinds that are going to be much more readily available to use in smart contracts and actual business transactions, right?
Yep.
Accounting, et cetera. So, and I think it was Solana, Ethereum, and Bitcoin were the big three at the beginning, and there'll be additional ones coming in there. Stable coins, I imagine.
Certainly. I think XRP is going to be one of those as well. More to come on this. Certainly, it's just in its infancy right now, but very similarly for that strategic reserve, it's just other, cryptocurrencies that our government has gotten hold of that they're basically not going to sell during that time frame as well.
So that inherently would tell me that the value of these assets, this is, I don't want to say it puts a floor, but it almost puts a floor under the price of some of these assets, because if the government's going to hold them, there's less float, right? Like we would call stock. There's less Bitcoin available. And again, we already think about 10% is gone forever of the 21 million that there can be, right? And so if the government starts to acquire and hold them, that absolutely means their inherent value, their intrinsic value is going to increase over time. So I think that bodes well for the future of it, at least as an asset price. Again, I know there's folks that follow like Charlie Munger and Warren Buffett's of the world. We don't understand it. We don't own it. But this is something people need to at least get their head around. It's here to stay.
Yes, very interesting space. And as we were just discussing earlier, certainly the regulation around it is something that's going to be very big and hopefully coming this year.
Okay. So, and Ethereum is, again, one I've talked about in the past that I kind of like because of the use in the smart contracts. You kind of go through that in the class that are coming up. You actually talk about how blockchain sort of works. I mean, not too deep, but the basis of it, right? So I think that bodes well. We also have legislation in committee in the Senate and in the House that will, validate owning these, right? Because one of the things in the previous administration and in the previous SECs, is it a currency? Is it a security? And XRP just won their lawsuit, right?
Yes, they did.
So it is, and so stable coins are not going to be securities. They're going to be basically used for transactions. It's just like using a Venmo or a Zelle or some other form of digital payment system. So that's going to put the validity of those stable coins pretty high up there, right?
Yeah, certainly. And, as we were kind of joking around this morning, I'm dealing with that with my CPA right now of trying to, some of the things that I sold last year from a tax perspective of some of the cost basis didn't carry forward. So now I'm hunting that out in the background. So yes, more regulation would certainly be welcomed in this industry to make it just more transparent.
Well, that's what industry wants in general. We just want to know, what are the rules of the game that we're playing by, right? And can we have some stability with those rules, not changing things around? And that's kind of the riff of what's going on in the equity markets right now with tariffs and how long are they going to be here? Are they real? Are they stick in all this information? But now I think it's interesting too, in the time we got left, and you'll probably talk about this in the class even, obviously, this administration is much more pro-crypto. We saw a huge bump in the price of crypto assets after the election in November. They've since sold off, as a lot of other risk assets have, the first quarter of this year. But you just saw, we just saw the Trump's two boys, Eric and Don Jr., I think, right? That and took a pretty big stake in a company that is a mining company that's going to be mining here in the U.S. Is that right?
That's correct. So that's actually going to be Hut 8 is the name of the company, and they're going to be 20% stakeholders in this company. So 80% still will be remaining owned by Hut 8. But long and short, they have 61,000 mining machines in this entity that they're going to be able to help. And I believe some of that is going to be helping on the strategic reserve, but more to come on that.
Yeah, that'll be interesting to follow. And I just think there's so many fascinating stories that come out of this. The energy consumption required for such an operation. 61,000 mining machines. I don't know what the energy level is needed for that, but it could probably run the city of Omaha, right?
Probably.
Or even maybe bigger. I don't know exactly. But energy consumption is going to go up. So that's, again, getting back to this administration's, they're trying to drive down the price of energy right now, the cost of oil, et cetera, for production of kilowatts, et cetera, because quantum computing, AI, Bitcoin mining, crypto, this is only going to put more pressure on the the grid, as we call it. But how do you protect the grid? Well, blockchain technology can actually be used to encrypt and protect these things from hackers. Tell me a little bit about what are the current fears out there now that we have quantum computing has become a real thing. It's in its infancy, but the breakthroughs are there. That was one of the things that spooked people about cryptocurrencies, maybe 2 months ago when this was announced, that what if they could actually crack the algorithms, the security of these digital assets? Yeah,
so that's a great question. And I discussed this a little in the last class that I went through on the quantum computing. And ultimately, right now, the problems that the quantum computing can solve are very, very structured and basically in the same direction. So I want to say it was like right around 1,000 was the number that it can get to today. And it's going to need several million to crack Bitcoin's coding, if you will. With that said, I would argue that, if you can crack Bitcoin's coding, you can crack just about anything on the planet. So
it also tells me that they would be able to create new encryption. So there may be a future version of a Bitcoin created,
no question,
from quantum computing. Again, there's so much to unpack here. So, all right, look, we're running out of time for this week, but I think this is fascinating stuff. Whether you're investing in crypto or you just want to understand it because it will be part of our future, this is a great class to attend. So it's going to be, again, at the Midwest Learning Center. That's coming up this Wednesday, April 9th at 6:30 p.m. right here at the Midwest Learning Center. So give us a call, 402-369-7777, or go on the events page, retiresmartnow.com, find the events page, and register. You do need to register. Thank you, Brad, for coming in.
Thank you, David.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about required minimum distributions. My wife and I are in our 70s and taking RMDs. If one of us dies and the other inherits the IRA of the deceased spouse, what is the tax impact?
Pain. Usually, not 100% of the time, but
why?
So this happens all the time, Chip. So when you pass away, your wife Pam would inherit your IRA.
Okay.
And now she has to take RMDs. Once RMDs have been turned on, they cannot be turned off anymore. So there's some changes in recent laws and legislation. So even if the spouse was not of RMD age, they're still going to be taking RMDs. Now, those RMDs are taxable income. And if you had two IRAs in this example, both those RMDs, we were filing a joint tax return while we had both spouses alive. So we had a much bigger bracket of income to put in the same tax. So typically when we lose a spouse, we're going to lose one form of guaranteed income, sometimes more if they have guaranteed income like pensions. But we're going to lose that Social Security check of the smaller check typically of when a spouse passes away. So we have the large Social Security check and then those RMDs. But that income typically pushes the single filer into another tax bracket.
Is this another version of the widow's dilemma?
Absolutely it is. And so they end up paying higher tax on those distributions. And then if the IRAs are big enough, those distributions put them over $103,000 this year as a single filer, you would then pay additional taxes on Medicare B and D. Those are the IRMA penalties.
Just changing that status from joint to single filer just walks you right into a buzzsaw.
And again, I met with a couple in their 80s this week, and this is the problem they're having now is their RMDs are getting big enough that they're actually paying IRMA penalties while they're both here. And I explained to them that I quickly showed them some math. If we lost one of them, and that's a reality that they know is coming at some point, the survivor goes up. They're in the first penalty line for IRMA right now.
You're talking about IRMA penalties. You're talking about a Medicare-related penalty because your income is too high.
There's 5 such penalties, so there's lines. And so the survivor in their situation was going to jump from one penalty to the third penalty line. And most people have no idea, but for the average married couple we see, it's additional $100,000 in taxes that you're paying via Medicare penalties over the lifetime of both spouses, when a lot of this can be eliminated with proper planning ahead of time. But we do have to plan. And so, again, this is, you don't know what you don't know.
That was exactly the phrase running through my head.
And this is where tax planning is so critically important.
Next question, David. This is about philanthropy. I want to help send my grandchild through college. What's the best way to do it?
Well, there's a lot of ways to do it. I would tell you it's great that you want to do this. So a 529 can become a valuable vehicle to utilize here. And the reason a 529 has become more advantageous is you can put money in a 529. And by the way, if they're in K through 12 school, depending on what state you're in, you can use it to pay for private school as well. But you get to write off up to $10,000 on your state income taxes each year of those payments that you're making for your child. So don't just write the check to the college. If you're going to pay the tuition, right? If you're going to send your granddaughter down to UNL, don't write the check for $10,000, $12,000, $13,000 or whatever when you're writing that check. Put it into the 529 NEST program on that child's behalf. It sits in there one day and comes out the other side. The 10 grand goes to you can take it out to pay the tuition, but now you've reduced your state income tax by that $10,000.
Let me back you up just to this extent. You say 529, do a 529. What is a 529?
So 529 plans have been around for over 2 decades. It's basically a college savings plan that allows you to, there's no tax savings federally. Now, you can invest money inside these plans. It grows tax deferred in the plan, and then it comes out tax-free if you take it out for college expenses. On the state level, though, you get to write off what you put in there. So you get to deduct it from your state income tax. So it's very different depending on what state you live in, how this works. Like I was in Florida, had a 529 plan for my boys, but I lived in Florida, no state deduction. We didn't have income tax. So I got no state deductibility from that. I just got tax deferred growth. So I actually used Alaska's 529 plan because it has the strongest asset protection laws on those 529 plans for someone of means like myself. Again,
do you have to own property or have some connection to the state?
Can buy it in any state you want.
In the state.
Again, if you're in a state that charges income tax, you're most likely going to want to use that state. But again, when you live in one of the now 10, we'll talk about that later, 10 now tax-free states of income tax, you could utilize another state's program. And there's a lot of benefits to that. And again, Florida has what's called a prepaid program that runs side by side with that, where you can lock in the tuition today and just pay it off. No matter what it inflates to in the future, you've already prepaid that tuition. So again, there's a few other ways you could do this, but that's a great reason to get a 15-minute phone call with one of our advisors. That would be a great discovery call to find out the best way to set up that college plan.
Next question, David, is about income security. My wife and I are 56 and starting to think seriously about retirement. We have a few 401k and IRA accounts, but we've been on autopilot, not making any plans. We should have about $1 million saved by the time we retire in a decade or so, but it seems like such a blind leap. How do we know if that's enough? How do we figure out what we will need for 20 or 30 years, especially when we have no idea what will happen with the economy, the markets, and other factors?
Well, the average retirement lasts just under 24 years. You're going to retire, at least what you're telling us, in about 10 years. So that's 35 years or so of planning here, right? And again, that's why you need to have a plan. So you do not want to make long-term decisions on short-term data, all right? So in other words, don't worry about the markets or the tariff day, things like that today. You're not planning on touching these funds for about 10 years. Now, you certainly want to understand how to risk allocate those assets. You don't want to go backwards 30, 40, 50% in what you've saved thus far. So you need to have an allocation plan that helps you understand why diversification is so important. You really want to start thinking about a tax plan as well to pair alongside that, because as you mentioned, most of your dollars are in 401k and IRA dollars. Those are the worst tax assets you're going to own once you're retired. Some of the reasons we just talked about in the previous question. So we would want to start the plan now. It's a great time, by the way. We have a lot of folks that come to us in our 50s to start putting the plan together. Even though those assets are going to stay in your 401k, et cetera, while you're working, you want to get an asset allocation and a tax diversification plan put together now. Then we want to determine, that's what a good plan will do, how much income are you going to spend in today's dollars. Chip, we'll take care of the work and inflation adjust that for when you're going to retire 10 years from now. But most people, their expenses are going to more than double in their retirement because of inflation. So We want to have a written income plan, inflation adjusted, that shows you how much income you're going to need. And then we can determine what the number is. How much do you need at retirement? And how much would you need to grow that portfolio through retirement? But you have to know your numbers. And again, that starts with planning. So sitting on auto drive won't get it done. And not looking when you see turmoil in the markets, I don't want to look. That's not the answer either. Be proactive. Understand how your assets are allocated today. Is it appropriate? Are you comfortable? Again, if you're losing sleep at night, you're probably in the wrong stuff, right? But get an action. And you don't have to come see us, by the way, right? But you should see an independent fiduciary-based advisor who does a true holistic plan and will put together a tax plan, income plan, asset allocation plan, and then even talk about legacy planning. And then, as you know, Chip, we have to talk about the what-if scenarios. I mean, we're covering a lot here, but what if both of you don't make it to retirement? There's so many what ifs in there. We need to factor all those things into the equation and build a true holistic retirement plan. We call it a smart plan, but whoever you go see, make sure they're covering all the areas and the bases you want covered.
Well, that's why we have the smart plan, a comprehensive, holistic approach. The question is valid in that, yes, there are a lot of variables, but time and experience have shown with the proper planning, as you say, you can account for everything. And as you say, you can get a decent night's sleep, but it takes some planning. All right. Up next, more states are breaking with conventional wisdom and eliminating time-honored forms of taxation. We'll explore that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. David, we are going to dig into state taxation here. And the first one up, it's a Fox Business headline, how eliminating property taxes in Florida could affect the state's real estate market. Now, we just looked at some stories about how some states are pushing back and saying, why do I have to keep renting my house from the government? Now, this is taking it a step further in Florida and looking at how it could open up a housing market that, as we noted in recent weeks, is kind of stacked up, right?
Well, yeah, we've had a massive influx of residents into the state of Florida over the last 5 years, right? We saw that major transition of states that kind of locked down harder than others that were open for free economy during the COVID pandemic, et cetera. And Florida was obviously one of the biggest net benefactors of that, along with Texas and others. But with those influx there, the housing market was not able to keep up. The inventory, there was not enough inventory, and people were going there with stimulus checks and free money from the government, which we know they shouldn't have sent out. But anyway, so it drove housing prices to the point where it's just unattainable, unaffordable to purchase a medium home in the state of Florida. My son lives there. I own property there, but the market has gone crazy. I own a condo that my son rents from me, and that more than doubled in value in the last 5 years. Doubled in value in 5 years. Now, looks great for me on my balance sheet, but again, can someone afford it? He could not afford to go purchase it at the current valuation if he was, and he's got a decent job and his significant other works as well. They could not afford to go get a mortgage on that. Interest rates are up, valuations are up. On top of that, property taxes have gone up with these valuations, and then the insurance costs we've talked about a bunch over the last years have gone up. So the total cost of that ownership is over 300% higher today than it was just a decade ago. 300% increase in a decade to own the average medium home. So that's put it out of reach. So if they eliminate property taxes, that at least puts some help in there, right? And that might unlock this market to get more inventory to come, or get it to where people, if they don't have to pay property taxes, could afford a little bit heavier mortgage and would get some transactions going. And so, I just think long term it's beneficial. It would benefit the state of Florida. It's going to benefit the valuations there, because if you don't have to pay property taxes, it's inherently more valuable than a house of the same price that you do have to pay property taxes on, right? So it's simple economics. But in the short run, it would help very quickly maybe get some transactions on the books, which, by the way, the state of Florida would love, because then they would collect tax, capital gains tax in some of those instances, et cetera, and the cities would have some revenue from dock stamps, et cetera, on deeds, all those things. So it would be an economic windfall. However, they have to make that revenue up elsewhere. We talked about it here. You can't just, are you shifting taxes or are you eliminating them, right? And most of the time, the reality is they have to shift them because they still need the revenue. Now, Florida has had a surplus of revenue for many years in a row. So they actually may be able to eliminate property taxes. And long term, that's going to be pretty strong, bode well for their economic viability going forward. Now, I will tell you, it's constitutionally, you cannot charge income tax in Florida. That's in the Constitution. Would they go so far as just pass as a temporary law on property taxes? Could it come back with a different, different governor in the future? I don't know. I haven't read deep enough into it, but you are right, Chip. States are moving in the direction of less regulation and less taxation, and the American public is responding with their wallets. They're moving to states that are doing that.
Well, there's the segue to the next story, David, and you hinted at this earlier in this show. You sent the team word of Mississippi. Mississippi now is, what is it, the 10th state now to eliminate state income tax?
Yes, it is. And this is going to explode. Mississippi is going to have a lot of folks decide to move there, right? So one of our employees lived in Mississippi for many years, just on the border of Tennessee, just south of Memphis, Tennessee. Well, a lot of people that would work in some of those cities lived in Tennessee because Tennessee does not have income tax, one of the other states. So now if they were commuting to a job in Mississippi, well, now if it makes sense, they might want to live in Mississippi because they won't have to pay that income tax, right? And so you'd be amazed at how fast we'll see. And Mississippi is a state that needs economic activity, right? So it's one of those states that has a lot of poverty in it in certain areas. And so they're hoping, and the data says they probably will reap the benefits of this. So I would look to see industries move there and jobs get created there because people will want to live in a state that does not pay income tax. Now, Mississippi's got bordered on three sides there, so there's cities that they will pull people from, right? And you'll see growth in those border towns, which is going to bode well economically. So real estate in Mississippi will go up on some of those border towns, depending on how close they are to decent-sized cities that are just across the border in their border states. So this is going to be an economic boom for that. And every state that's done this has seen an economic boom, every single one.
The story surface, and I think of my brother. Yeah. You know him. He's a client. He's born and bred Omaha, and fourth, fifth generation Nebraskan. But he moved to Iowa a few years ago, bought some land right outside Missouri Valley.
And it made sense. Your brother's a smart guy, and he has a great career, and at the income he's earning, it was a big number.
It was a 4 or almost 5-figure number in annual property tax that he's now saves by setting up shop over in Iowa. And
none of that. He'll pay no tax. He pays no state tax on Roth conversions. He pays no state tax on income distributions from retirement accounts in retirement to the state of Iowa. And again, Nebraska legislature, are you paying attention? States that push things the wrong way get the wrong results.
David, you shared this story with me right before we sat down to do the show. Republicans eye 25,000 SALT cap as Trump's tax cuts take shape. So Trump's trying to put together a tax cut bill on Capitol Hill. In this context, SALT, we're talking about state and local taxes, right? I used to get kind of cranky about this as a state senator. I always thought that this rewards the fiscally irresponsible states. But I'm going to hold my tongue and let you take a swing at this. What's happening here, David, with the SALT cap?
Well, it absolutely rewards fiscally irresponsible states. And this is why they put it in the bill, because they're trying to get a few people to come across the aisle with them. So this is the olive branch being reached out. Selfishly, if this goes in effect, I benefit personally.
Well, let's define what it is, first of all, that we're talking about.
All right, so the SALT deduction is how much of what you pay to your state or local taxes, income taxes, property taxes, and the like, and even sales tax if you pay enough. You collect all these taxes you pay, you can deduct that from your federal income and not pay federal income tax on it.
So the local and state representatives say, oh, don't worry about how we're gouging you. You can deduct that all from your federal taxes.
So states like New Jersey that charge double-digit income tax and high property taxes, right? If you paid $40,000 in taxes in the state of New Jersey before the tax bill went into effect that we currently have, you got to write all that off your federal income. So if somebody was a nice dual income family, a doctor, a lawyer, et cetera, and they were, let's say, in the 33% tax bracket, and they had a $40,000 SALT deduction, that would save them $11,000. They would not be paying their fair share, right?
Of federal taxation.
Right, of federal taxes. Yep. They would save over $11,000 in that scenario. Right now, we have a $10,000 cap on that. So here in Nebraska, a lot of us hit that because our my property taxes alone are higher than that on my primary residence, let alone other rental properties owned. So if they raise the deduction, I can deduct more, which means I'll pay less federal income tax. So this would benefit me selfishly. But this is an olive branch to blue states to get even Republicans in the House to come along with this that represent districts in New York, California, New Jersey, and the like. Now, just so you know, to pay for this, they're actually going to increase, or they're going to reduce some of the deductions corporations can deduct in the same manner. So corporations will be able to deduct less to pay for this for the average citizen. Again, this administration, and people don't seem to get it, his cabinet has more Democrats than Republicans in it. All right. I'm going to say it again. Trump's cabinet has got more Democrats and independents in it than Republicans. And I don't think a lot of people understand that. This is laser focused on helping the working man in high tax union states like Michigan, right? Wisconsin, New Jersey. That's what they're doing this for. And again, the rhetoric that you hear from the talking heads on TV doesn't say that. So again, we'll see what happens. And again, we'll know here pretty soon, because it looks like we're going for the one omnibus bill that will get passed before Memorial Day. And then we'll at least have some kind of understanding of the current of what the policy is going to be.
Well, as you and Brad were talking about, businesses, they just want to know, what are the ground rules? What's the lay of the land?
I need to know what the rules are and how long are those rules going to be intact for, and then I can plan for our clients.
Yeah.
That's what I want to know. But when you change it every week, it's a little hard to do some planning.
Just a quick shot here, David, to finish off on a positive note this week. Fox Business headline, Roth IRAs are all the rage with the young crowd. I've heard you in tax presentations talk about when you started as a financial advisor a quarter century or so ago, nobody had heard of the Roth. Maybe about 10 years ago, it was heard of, but not common. Now, even young people have gotten the word. The Roth gospel, the Roth good news apparently is finally spreading.
Yeah, because this money is compounding tax-free until you need it. And if you follow the rules, you'll be able to pull all those dollars out 100% tax-free. On top of that, for young people, why we encourage it, Chip, is you can take the money out. In other words, you can put $6,000 in your Roth, $7,000 in your Roth each year. You start putting money in there. In an emergency, you can take that money out. You've already paid tax on it. There is no penalty. And so many people, taxpayers don't know this. Some CPAs don't know this. A lot of financial advisors don't know. What they have to leave in the account, Chip, is the growth. So they invest it. They can take their contribution back out at any time, but you have a 5-year clock on the growth, and you must be 59.5. If those two rules are met, all that growth will come out tax-free as well. So it's the first place we want young people to invest in. Even in an emergency, if they had to go pull $5,000 out of there, it's their contribution. They've already paid tax on that money, and they're able to access it without a penalty, where you can't do that on the traditional side. So incredible tool. You should be talking to your kids, if you're our age, about utilizing this tool.
First thing I did when I came to work here, all our kids set up a Roth account at Retire Smart. All right, that'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week. It looks like spring is really here.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.